Good evening, ladies and gentlemen. Thank you all for joining us this evening for this webinar. I would like to introduce our speaker for tonight, Ms. Ferlyn Tan. Ferlyn is an equity analyst with the research team at iFAST Singapore, providing analysis and research coverage of both stocks and ETFs listed on the Singapore, Hong Kong, and US markets. Apart from also providing equity views through various media platforms, including 联合早报 and 963 FM, Ferlyn is also an avid investor herself. Tonight, she will be sharing with us about how the newly updated edition of the ETF Focus List was put together. So with that, I'll hand over the time to Ferlyn.
All right, hi, good evening, everyone. Thanks for tuning in tonight, and I hope everyone is doing well during this circuit breaker. So thanks, John, for the introduction. My name is Ferlyn. I am from the FSM1 Stocks ETF Research Team. So today I'm here to share with you guys on the latest update of the ETF Focus List. But before we dive right into explaining the changes we have made, we will also be sharing and running through the selection methodology for the ETF Focus List, which we hope will be useful for your own due diligence process as well. All right. So here is an outline of the three main things that we'll be going through tonight. First, I will kickstart this webinar with a quick introduction to ETFs. And then we will move on to our selection methodology for the focus list. We will share with you some of the factors to look out for before you select an ETF. And finally, we will get to our ETF focus list that we have updated just 1 week ago. And from there, we will share what are the new changes and additions to the list. Okay, so let's begin with the introductions to ETFs. First of all, an ETF, also known as an exchange-traded fund, it is a basket of securities that tracks an underlying index. So these indices are usually of a certain theme and can give you access to a portfolio of stocks, bonds, and etc. And most of the time, these ETFs, they are passively managed by the managers who aim to produce a return that replicates the underlying index. So you can think of an ETF that is something like a cross between a stock and a fund. So similar to stocks, they are tradable during market hours. They are tradable during on stock exchanges. And similar to funds, ETFs, they are exposed to multiple securities, and this can help to provide instant diversification for investors. So basically, they are an investment tools that allow you to track specific sectors or markets. So let's take this STI ETF, for example. So as the name suggests, the underlying index of the STI ETF is the Straits Times Index, which tracks the top 30 companies on the Singapore Exchange. So if you buy into this STI ETF, you actually own a stake in all of the securities shown on the screen above in just one single trade. So essentially, let's say you like the Singapore banks, you like Wilmar, SC Engineering, ThaiBev, etc. You don't have to buy into each individual stocks, but instead you can just purchase this STI ETF to get exposure to all these companies in one single trade. So such convenience is one of the many reasons that have resulted in a growing demand for ETF worldwide. So in fact, there are so many ETFs in the world now that allows us to reach every corner of the market. So giving us access to a variety of asset classes, industry sectors, and international markets. So here are some of the examples of the more commonly seen types of ETF. So we have ETF that tracks individual markets, as denoted by the STI ETF. There are also ETF that tracks specific industries, such as the semiconductor ETF. So there are also ETF that buys into fixed income and commodities, etc. And beside these plain vanilla ETF, there are also other ETF categories such as the smart beta as well as the leverage and inverse ETF. So let me just explain a little bit more about the other categories of ETF. So for smart beta ETF, they usually use rule-based system for selection of investments to be included in a fund. So for smart beta ETFs, they don't employ the typical market cap weighted index strategy, but instead they take into account other factors such as growth, earnings, momentum, value, dividends, etc. And as for leverage ETFs, so as the name suggests, you know that they seek to amplify the daily returns of its underlying index, and the amount of leverage is dependent on the prospectus. So, and as for inverse ETFs, they aim to deliver a daily return based on the inverse performance of its underlying index. So if you can look at the chart on the right, the benchmark index is denoted by the gray bar. So if the benchmark index increases by 1%, the 2 times leverage ETF will increase by 2%, while the inverse ETF will fall by 1%. So on the other hand, let's say if the benchmark index falls by 1%, the leverage inverse will fall by 2%, whereas the inverse ETF will increase by 1%. Okay? So over the past decades, all ETFs have gained tremendous popularity, and total ETF AUM has grew to almost 6.4 trillion as of end 2019. So there are over 5,000 ETFs today, covering most major indices globally. And in fact, the total ETF AUM is forecasted to almost double by 2023. So naturally, there must be a reason why these ETFs continue to be such a well-loved product by both the retail and institutional investors. And in fact, there are several reasons why people like ETF. So number one, the low cost. ETF, they are generally much cheaper than active mutual funds, and this can help investors to save on costs. So an ETF's expense ratio can go as low as 0.02%. And if all else equal, we know that lower cost equates to higher net returns for the investor. And secondly, diversification. So like what I've mentioned earlier, an ETF is made up of many individual securities. So this provides instant diversification since investors are less exposed to company-specific risk as opposed to holding individual stocks. And then the third advantage of ETF is accessibility. So ETFs help investors to gain a wide range of desired market access easily. And sometimes ETFs can also help to provide access that may not be available to retail investors like us. So for example, fixed income bonds. We know that corporate bonds, they are usually in sizes of 200,000 or more, and they are only available for accredited investors. But thanks to the emergence of ETFs, we can now tap into this market, which was previously deemed as impossible for investors like us. Yep. And fourth reason why ETF is so popular is probably because of its flexibility. So ETF, they can be traded at any time during the market hours. So this allows investors to enter and exit positions very quickly. And given how ETFs are traded on exchanges like stocks, it means that as investors, we will know the exact price of each transaction, which brings us to our final point on transparency. So the final advantage I'll be sharing tonight is about transparency. ETFs are highly transparent because their holdings are published on a daily basis. So this means that you know exactly what you're buying into. All right. So now that you have a better understanding of ETFs, maybe let's go through some of the things that you should also take note before you select an ETF. So here we have some of the factors that we have identified as important. And do take note that this is also taken into account in our selection methodology for the ETF Focus List. Okay, so we have classified the factors into two categories, namely the quantitative and the qualitative factors. So under the quantitative factors, we look at three things: the tracking difference, the expense ratio, and the ETF's liquidity. And as for the qualitative factors, we look at the choice of index, we look at the underlying index, as well as the structure of the ETF. So first, let me explain a bit about tracking difference. So tracking difference is the difference between ETF's performance and the performance of its underlying index. So given how ETFs is supposed to be an index tracking product, there's no doubt that a smaller tracking difference is more desirable. However, I think it's important for us to understand that there will be a tracking difference between the ETF and the underlying index due to a few main reasons, such as the expense ratio, rebalancing costs, securities lendings, etc., etc. So at the end of the day, while tracking difference is unavoidable, the ETF that can consistently produce a smaller tracking difference will be the more desirable one. Okay, so the next factor we look at is the expense ratio. So this is a very straightforward point. As we all know, the lower the cost, the better for everyone. So the expense ratio is essentially what you pay for the operating expenses and management fees annually. And they are expressed as a percentage of ETF's average net assets. And as you can see on the table on your screen, the higher the expense ratio, the bigger the negative impact it has on your overall return. So every basis point actually have a larger effect on your returns than you may have expected. So in other words, lower expense ratio can help investors save on costs, which will help to result in generate a better return for the investors. All right. So the third factor is liquidity. So liquidity refers to how easy it is to buy or sell an ETF quickly. So unlike stocks, ETF have two layers of liquidity, namely the primary and the secondary liquidity. So let me just focus on the primary liquidity first. The primary liquidity is determined by the liquidity of the ETF's underlying securities. So one key feature of ETFs is that they are open-ended investments, which means that they can be continuously created and redeemed whenever there's an excess supply or demand in the market. Which means to say when there is a higher demand for this ETF, the ETF managers will actually need to look at the primary liquidity, which is the liquidity of the underlying securities, in order to create new units of the ETF. So this process, do know that it's only required when placing a large trade, and they are usually on a scale of 10 of 1,000 shares. And usually the main participant in this primary market are mostly institutional investors. So fortunately or unfortunately, most of us do not trade 10 of thousands of shares of ETF shares at any point in time. So to us, we believe that primary liquidity may not be the most relevant measure of liquidity for us. Instead, we believe that the secondary liquidity, which is the on-screen liquidity, might be more relevant for us. So the secondary liquidity is determined by the volume of the actual ETF shares traded. So if we look at, so when it comes to analyzing an ETF, we will look at statistics such as the average bid-ask spread and the average trading volume. So, and of course, we will prefer a more liquid ETF. So when choosing the ETF for our focus list, we will usually lean towards the one with a higher average daily volume and the one with the smallest bid-ask spread. Okay. And now, moving on to the qualitative factors, we look at the choice of index, the underlying index, as well as the structure of the ETF. So when you choose an ETF, we believe that you should be aware of the underlying index to understand what you are getting yourself into. So although this statement may sound a bit duh, but the reason why we think it's important is because there are actually some ETFs out there that may have pretty misleading names. So for example, let's say you came across an ETF called the Middle East and Africa ETF, and you want to buy it because of the exposure to both Middle East and Africa. And your first intuition is probably that you're expecting a 50-50 weightage. But in fact, it may only have about 5% holdings in the Middle East or 5% in Africa, vice versa. So either way, yes, it's not what you're expecting, and therefore we think it's actually very important for you to look through the holdings of the ETFs before you decide on it. All right. So for our ETF focus list, we will usually look at the top 10 holdings to roughly gauge if we like this ETF. And so we also check if the ETF is too concentrated in its top few holdings, and if yes, is it okay if it has a higher concentration on the top few holdings. And the good news is that you can actually view each of the ETF's investment objective and also their top 25 holdings from our fact sheet as shown on the screen here. So hopefully this will bring you bring you the convenience that you need when you research for your ideal ETF. Okay. And moving on to our final point, final qualitative factor, which is the structure of an ETF. So when it comes to the structure of the ETF, it can either be physical or synthetic. So most ETFs are physical, which means that they hold the actual underlying securities that make up the index. So do also note that physical ETFs can either be fully or partially replicated. So in partial replication, it means that the ETF holds only a sample of the index. And partial replication approach is normally used when there are liquidity issues or large number of holdings in the index. So making full replication very difficult and costly. So I think a good example would be bonds ETFs, because bond indices, they usually contain thousands of constituents. So therefore, I think it's very obvious to see that it's very unrealistic for the ETF manager to buy all the issues just to replicate the full index. So therefore, in such cases, partial replication would actually make more sense. Yep. So other than physical ETF, there are also synthetic ETFs. So synthetic ETFs, they rely on derivatives such as swaps, futures, and forward contracts to execute their investment strategy. So do note that because synthetic ETFs rely on derivatives, it actually exposes investors to counterparty risk. And of course, that doesn't mean that they are bad just because they are synthetic ETFs, because synthetic ETFs can provide a competitive offering for investors seeking to invest in liquid market. So one good example would be oil ETF, because most, if not all, oil ETFs are synthetic ETFs, because it is very costly and difficult for the ETF managers to take actual physical delivery for the oil. So in this case, most managers will invest in oil future contracts instead, which tracks the price of crude oil. Okay. So now that we have discussed the selection criteria that we look at, here's an example on how we select the ETFs for our ETF focus list. So in this example, we will be looking at the Singapore category. So first, what we do is that we will screen out the ETF that tracks the Singapore economy. And next, we'll pull out the statistics required, which are the three quantitative factors that I've highlighted earlier on, namely the expense ratio, the liquidity, which is represented by the bid-ask spread and average volume, and finally, the tracking difference. So as you can see, each factor is assigned a weightage based on their relative importance, and the score is given to each line item as shown above. So we will then give a score to each ETF using the weighted factors, and we proceed to sum them up and rank them based on their scores. So after filtering using our quantitative factors, we then proceed to look at the qualitative factors such as the choice of index as well as the structure before making our final decision. So for our ETF focus list, we generally prefer physical ETFs, which buy the actual shares of the underlying index. Okay, so in this case, the Spider STI ETF is our preferred choice in the Singapore category. Yep, so just a quick disclaimer here, just because the other two ETFs are not ranked number one doesn't mean that they are not good. So as you can see, the set of results is very dependent on the weights assigned to them. So perhaps if you think that liquidity is much more important, you think that the average bid-ask spread is more important, you can reassign and score them based on what you prefer. So overall, I think it's important to keep in mind that while these ETFs do not guarantee superior returns over their peers, the ETFs that were chosen, however, do have an edge over the peers, over the others based on our selection methodology. All right. So, and finally, to the highlight of tonight's webinar, let us introduce our latest update on our ETF focus list. So to those who are not very familiar of our ETF focus list, just want to do a very quick sharing. Our ETF focus list is a specially designed list of over 40 ETFs across 6 categories. And within each category, there are several subcategories where a single ETF is highlighted. So the ETFs on the list, they are screened based on the quantitative and qualitative factors that were mentioned earlier. So we take into account the expense ratio, liquidity, the tracking difference, and like I've said, they are generally the plain vanilla kind of ETFs. And to navigate to our focus list, you can go to our homepage, our FSM1 homepage, and from there you can go to the ETF or the research tab, and you will be able to find a button that will lead to our ETF focus list. Yep. So we introduced the ETF focus list in 2018 to guide investors with their ETF selection decisions. So this list is updated on an annual basis to ensure that our recommendations remain current and relevant for all of us. So this year is no exception. And by using the same in-house methodology as prior years, we have made some changes to the ETF focus list. And here are some of the more notable changes. So first of all, we have added digital economy into the core equity category. So digital technology has revolutionized the way we consume information, entertainment, goods and services. And in fact, it has become an indispensable part of our everyday life. And on top of that, the COVID-19 pandemic, it has further accelerated the adoption of digital technology across all aspects of our life. So while there's currently no universally agreed definition of the digital economy, the digital economy consists of such segments like the e-commerce, e-services, e-travel, fintech, cybersecurity, and so on. And if the digital economy were a standalone national economy, it would be the third largest in the world, just behind US and China. So here's a few examples to illustrate the growing opportunities within digital economy. So number one, e-commerce has indeed come a very long way since its inception, and it has now become a major part of our everyday lifestyle, with consumers across the world taking advantage of the convenience of ordering anything and having it delivered right to our doorstep. So I think the COVID-19 pandemic has also changed our consumption habits within just a couple of weeks. I think more than just young adults now have moved to e-commerce, and we believe that this fundamental shift in our behavior is here to stay, and they will most probably become the next normal of our day-to-day lives. So therefore, we see a huge opportunity within the e-commerce space, and in fact, by 2023, global e-commerce is set to become a 6.5 USD trillion opportunity. And besides, not only has internet changed our shopping habits, it has also changed the way companies advertise their products. So with consumers spending increasing amounts of time on the internet compared to the traditional media, digital advertising is now a necessity for companies that want to maintain a strong online presence. So the digital advertising market is expected to be worth over 500 billion by 2023, and that's a CAGR of about 12% from now to 2023. So as a shift towards digital advertising continues, the largest digital ad sellers will likely be the main beneficiaries. So therefore, in short, we believe that there are still countless of investment opportunities within the digital economy. And to reflect this growing importance of digital economy, we believe investors should have an allocation to the digital economy in their core portfolios. And next, the other big change we have made is that we have moved China from single market equity to the core equity category. So as we all know, China is now the world's second largest economy, accounting for about 15% of the global GDP. So it has also been one of the world's fastest growing economies since it first opened up its country. Yet, until now, China currently accounts for less than 5% of the global equity benchmark. Hence, to reflect the growing importance of China, we have moved China from the single market equity category into the core equity category. And on top of that, we have also added a new addition to the focus list. So when it comes to Chinese equities, they can be a little complicated given how there are so many different types of share classes listed on all over the world. So while the majority of them are still listed on the mainland exchanges, such as the Shenzhen and Shanghai Stock Exchange, there are a handful of companies that have chosen to list on other exchanges like the Hong Kong Exchange, New York Stock Exchange, and Singapore Exchange. So therefore, with so many different share classes available, investors may often find it very difficult to choose which share class they should invest into. And besides most China-centric ETFs, they only provide exposure to one single share class, which means to say, if you buy into an A-share ETF, you will only have exposure to the A shares, and you will not have exposure to the Hong Kong stocks, Hong Kong listed stocks like Tencent. And on the other hand, let's say if you own H-share ETF, you will miss out on some of the A shares, the prominent mainland Chinese companies like Guizhou Maotai, which is the world's most valuable liquor company. And finally, let's say you own both A and H share, you will still lack exposure to the China's homegrown search engine giant Baidu because it is listed in America. So I hope you know where I'm coming from. And therefore, if you're an investor who wish to obtain a complete exposure to all Chinese equities without having to pick a share class, you may have to own multiple ETFs. So therefore, in light of this challenge, we have decided to add the total China as a new category in our ETF focus list. So investors who wish to capture the entire growth potential of China, regardless of share classes, should pay attention to this new category because the ETF highlighted here will give you exposure to almost 1,000 Chinese companies across all stock exchanges. Right. So moving on, we have made 10 new changes in total, most of which are new additions to the ETF focus list this year. So first, under the core equity category, we have replaced the old ETF under US with Vanguard S&P 500 ETF due to a slightly lower expense ratio. And as mentioned earlier, digital economy and total China, they are both new additions to the list. And we have chosen the OGIG ETF as the ideal representative of digital economy given how it has a more competitive expense ratio as well as better liquidity compared to its peers. And as for the Vanguard Total China ETF, while it has a high expense ratio at about 0.4% relative to some of its peers, we believe that it more than makes up for it with its comprehensive exposure and higher liquidity. So next, we have also added 5 new categories to our tactical playlist. So we added US Internet and have chosen the First Trust Dow Jones Internet ETF as the ETF for you to get exposure to the US Internet companies. So note that investors who prefer exposure to global Internet companies should opt for the OGIG ETF instead. And next, the Global Financials and Global Healthcare, they are both new additions as well. So both ETF chosen are issued by iShares, and they are chosen for their superior cost effectiveness and liquidity over their peers. And next, investors who are keen to ride on the long-term trend of China financial sector can consider gaining exposure through the Globex MSCI China Financials ETF. So this ETF provides access to almost 100 companies across the entire Chinese financial sector, which include companies like the banks, the insurance company, and the capital markets company, etc. So we believe that this Globex MSCI China Financials ETF, this category, it will be a good complement to our existing ETF, the BMO Hong Kong Banks ETF, which offers targeted exposure to just the Chinese banking industry. And finally, as for cloud computing, investors who wish to participate in the upside of this long-term growth story can do so easily using the First Trust Cloud Computing ETF. So this ETF has one of the lowest expense ratio and the best liquidity amongst its peers. And for a deeper understanding on the cloud computing industry, you guys can head over to our FSM1 homepage where my colleague Jun has actually shared more about this in his article. And finally, for our commodities category, we have also swapped out the OETFs under gold and crude oil. So for gold, we believe that the Spider Gold mini shares is more cost effective with an expense ratio of only 0.18%. And it is also much more liquid compared to its peers, hence making it our preferred choice for the gold category. And as for the crude oil ETF, we have replaced the old ETF with the Invesco DBO Fund, ticker code DBO. So this is due to the structural issues faced by USO ETF, where they have actually announced that they'll be making several changes to its investment strategy, whereby they have also warned that the steps taken may result in significant tracking deviations to its benchmark. So for a more detailed explanation, I believe you should take a look at the article written by another colleague of mine, Weiren, where he explained the concept of how oil ETF works and also what happened to the USO ETF. Yep. So, but either way, investors who are looking to bet on an oil price rebound, you can consider the DBO ETF instead, which utilizes a rule-based approach that's intended to minimize roll costs in contango. Okay. So, if you're a beginner investor and you don't know where to start your investment journey, we believe that you can actually consider engaging in our FSM1 ETF RSP program. So the ETFs available for RSP, they are mostly based on our ETF Focus List. So our ETF RSP is basically a monthly subscription plan that enables you to invest a small fixed sum of money into the selected ETF on 8th of every month. So we believe we are probably one of the first few players in the market to offer so many ETFs for the regular saving plan. And I believe we are also one of the cheapest in the market. So our commission rate starts from 1 SGD or 0.08%, whichever higher. And you can start as low as just $50 Sing. So needless to say, it is super easy and super cost effective to kickstart your investment journey with us. Okay. And finally, to sum up, we hope our ETF focus list will serve as a good starting point for everyone here with us today. And one last important thing that we want to highlight is that just because we have replaced some of the ETFs on our focus list, it doesn't mean that old ones are no longer relevant. So there are still viable options for your portfolio, and most importantly, they will continue to be available under our RSP. Okay, and for more detailed information about the changes, please refer to our link as shown in the screen over here. And just a shout out for our marketing team, we are also currently running a promotion where you will get to enjoy a flat fee of Sing dollar 10 for 6 of the SGX listed ETFs found on our ETF focus list. And this promotion will last until 18th of June. And for more information, refer to the link on the screen here. Okay? And with that, I've come to the end of tonight's webinar, and we sincerely hope that you now have a better understanding of ETFs.
Yes, thank you so much, Ferlyn. And also thank you all for joining us this evening to learn about our ETF focus list and how it was put together. If you would like to learn more, head over to our homepage, fsm1.com, and click on the ETF tab. Over there, you will see our ETF selector, as well as a list of articles of ETF investing ideas. Latest articles also cover the ETF focus list, where you can just head over and at your own time, you can also read and learn how we've put together this list. Also, one more thing to note is that the ETFs in the 2020 edition of the ETF focus list are also available via our ETF RSP feature. This gives you an affordable way to invest in ETFs via a dollar cost averaging strategy. And I'd like to thank you all for investing with FSM1.com, and we wish you a pleasant evening.